Welcome back to Investing Talk Podcast. Today we're taking a close look at SERV Robotics. You shared some interesting reports about their recent performance, and our mission is to unpack what's most important for you to understand.
That's right. We've got a detailed due diligence report, a company overview, and a breakdown of their Q1 growth and market impact. It certainly seems like there's a lot going on with SERV right now. I mean, impressive revenue growth, but also, significant financial backing and these ambitious expansion plans.
Definitely a lot to unpack.
So for you, as the learner, our aim is really to give you a clear, concise understanding of what these developments mean. We'll navigate these sources together, highlighting key insights, potential areas to watch, hopefully without getting lost in the jargon.
Okay, let's start with that revenue growth.
Good place to start. The reports highlight a pretty significant 150% sequential revenue increase in Q1 2025, reached $440,000.
150% quarter over quarter. Wow.
Yeah, driven by expanded fleet utilization, and they mentioned consolidating delivery and branding revenues. So what does this kind of growth trajectory typically suggest for a company at, this stage?
Well, that level of sequential growth, 150%, that's quite notable for an early stage company. It often signals, strong demand, suggests their model is gaining traction, maybe successful execution on sales and marketing.
Makes sense.
But you have to remember, early stage companies can have really volatile growth. Sustainability is, well, it's everything. This jump is significant, but is it like a one-off partnership, or is it really a consistent increase in revenue per robot? That's what you need to figure out.
And that mention of consolidation of delivery and branding revenues, understanding the specifics there would tell us more about how organic that growth really is.
Right. And they also reported building over 250 new third-gen robots in Q1.
Yes, increasing daily active robots from 57 to 73. And they're aiming for about 2,000 robots deployed by the end of 2025.
Okay, 2,000 robots. What are the logistical and strategic implications of scaling that fast? Especially with these sidewalk robots.
Well, scaling at that pace,
Yeah.
it's opportunities and significant challenges, right? Logistically, think about it. Production, deployment, maintenance for a growing fleet. You've got supply chains for parts, setting up operations in new places, charging, repairs. It's a lot.
And the costs involved.
Absolutely.
Yeah.
That doubling of operating cash used, it's directly tied to building and deploying those 250-plus new robots in the quarter. The upfront costs are huge materials, manufacturing, deployment.
Okay, but strategically?
Strategically, fast scaling helps grab market share, maybe build network effects. The more robots, the more customers, the more valuable the service becomes, attracting more users.
A virtuous cycle, potentially?
Potentially, but it needs massive investment up front and very careful management. You don't want to overstretch. And sidewalk robots in cities, that's complex. Different infrastructure, different rules compared to, say, warehouse robots.
And they are expanding geographically, too, aren't they?
They are. Actively expanding into places like Los Angeles, Miami, Dallas. Atlanta is apparently next.
How crucial is that geographic diversification for this kind of company? And what specific hurdles might pop up in these new cities?
Oh, it's very important. Getting into new cities means bigger customer bases, less reliance on just one market. But, each city is its own beast, right? Different regulations, operational needs, competitors. You need a really solid expansion strategy.
So navigating LA sidewalks versus Dallas sidewalks could be totally different challenges.
Could be. Density, pedestrian traffic, local rules. They'll need to adapt their tech and operations. It's vital.
Okay, let's talk money. They secured $91.5 million in new financing in Q1, ending March with $198 million in cash.
That's correct. And they project this will sustain operations through the end of 2026.
So what does that level of funding suggest about their runway and growth potential? Does it maybe cushion some of those scaling risks we talked about?
Well, securing that $91.5 million, leading to $198 million cash, it's a significant runway. Through late 2026 gives them valuable time to execute growth plans, invest in R&D, expand market presence without, immediate funding worries breathing down their neck.
And investor confidence.
It signals confidence, yes. Investors seem to believe in the long-term potential, and it definitely provides a buffer to manage the costs of that rapid scaling.
Okay, but here's where it gets interesting. Revenue grew, yes, but they reported an EPS of -$0.16 for Q1. Missed expectations.
And net losses widened too, $13.22 million.
So how do we square that? Strong revenue growth, but bigger losses. What usually drives that in a company focused on expansion?
It's actually pretty common for high-growth companies, especially in capital-heavy areas like robotics. These losses often come from big upfront investments, R&D, building infrastructure like all those new robots, plus the costs of scaling fast, like hiring, entering new markets.
So the idea is revenue eventually overtakes those costs.
That's the goal, yes, leading to profitability down the line. But missing EPS estimates, that can make investors a bit nervous about the timeline to profit.
And if these losses keep widening at this rate, even with that big cash pile, how does that affect the projection of lasting through 2026?
Good question. If losses keep widening significantly, it would definitely put pressure on that 2026 runway. It would mean they'd need to either ramp up revenue much faster or get costs under tighter control.
And related to that, operating cash used more than doubled year over year, $9.46 million, reflecting those high scaling costs.
Right.
Beyond just building robots, what specific costs are likely ballooning here? Is this typical for tech companies moving into new markets?
Several things likely contribute. Robot production's a big chunk, sure. But think about increased staff operations, engineering, sales to support the expansion, marketing, sales for new cities, plus just the operational costs of running a bigger fleet, energy, maintenance, it all adds up.
And then this pattern.
It's pretty typical, yes. For tech companies in a rapid growth phase, especially when pushing into new geographic areas, they're investing to capture market share.
Okay, shifting gears slightly. SERV is emphasizing monetizing its software platform. Recurring revenue expected from Q2 onwards. Why is this software shift significant?
The software angle, it's very significant. Software revenue, especially if it's recurring subscriptions, service fees usually has much higher profit margins than hardware.
More predictable too, right?
Much more predictable and stable revenue stream. Plus, a strong software platform can make their robot fleet more efficient, more capable, add value for customers, maybe attract more business.
Are the reports giving any hints about what kind of software services or the revenue models?
They don't seem to go into deep specifics, but you can sort of guess. Maybe advanced fleet management tools for their clients, like restaurants, real-time tracking dashboards, analytics, possibly even premium features for the autonomous navigation itself. Things customers might pay extra for. It feels like a key step towards long-term profitability.
Makes sense. Now, SERV focuses on software services and fleet revenues, specifically in this autonomous sidewalk delivery niche. How does that specialization set them apart from, say, broader delivery or automation players?
That focus is their niche. By concentrating just on autonomous sidewalk delivery, they can really tailor everything tech, operations, regulatory strategy to the very specific challenges of sidewalks.
So different from drone delivery or self-driving cars on roads?
Completely different. A drone company worries about airspace rules, weather, payload limits. SERV worries about pedestrians, lampposts, curbs, local sidewalk ordinances.
So their tech would be different?
Their software, their sensors, all geared for that ground-level environment. Pedestrian detection, navigating clutter, things an aerial drone wouldn't prioritize in the same way. This focus could give them a real edge in their specific sandbox.
Okay. The reports list strengths like innovative tech and financial stability, but also red flags. Dependence on technology, regulatory risks. Can you elaborate on those? What specific tech dependencies or regulatory hurdles could trip them up?
Well, the tech dependence is obvious, right? Their whole business relies on the robots working reliably, the AI being smart enough to navigate safely, the software being secure. Any major tech failure, a software bug, a security breach, that could be devastating for operations and trust.
And the regulations.
Still very much evolving. Cities and states are figuring out the rules, restrictions on where robots can go, speed limits, safety standards, permits. Even later rules around automation could come into play.
So lots of uncertainty.
Huge uncertainty. It's a risk for their expansion plans. We've seen other autonomous vehicle companies hit roadblocks with permits or public safety pushback. It's a real potential headwind.
Yet, despite the near-term losses, analysts seem optimistic based on revenue growth, scaling plans, and the stock price apparently jumped in May. What makes the market feel positive when a company is still losing money?
It usually comes down to belief in the long-term story. Investors see the potential. Strong revenue growth signals demand, expansion shows progress, maybe they like the tech, the market opportunity, the management.
So they're betting on the future.
Essentially, yes. The recent stock surge suggests investors are encouraged by SERV's growth and scaling, and they see the current losses as just, the cost of building for future profits.
So let's try to tie this together for someone evaluating SERV. Key risks: widening losses, high cash burn, regulations. Key opportunities, recurring software revenue, geographic expansion. How should you weigh these competing factors?
Carefully. It requires balancing. The losses in cash burn are serious concerns. You need to watch their progress towards efficiency. Regulatory changes are a wild card. But the potential upside from high-margin software and tapping into big city markets is also significant.
So look at execution.
Assess their execution track record, their ability to manage costs while scaling, and definitely stay updated on any regulatory shifts. It's a bet on future potential, acknowledging the risks in a fast-changing industry.
Okay. We have certainly covered a lot of ground exploring SERV Robotics. You should now have a clearer picture of that impressive revenue growth, their ambitious expansion, the strong financial backing, but also the challenges of scaling, clear in those widening net losses.
And that strategic focus on software revenue, that could really be a key turning point. Their position in this specific autonomous sidewalk niche, it presents both big opportunities and, well, definite risks in a market that's evolving incredibly quickly.
Which really raises an important question for you to think about. How do you personally balance that excitement around rapid growth and cool technology with the hard realities of ongoing financial losses and the uncertainties of, well, a pretty new industry? Keep an eye on their progress monetizing that software platform, and definitely watch their ability to manage operating costs as they keep expanding.
And for more detailed, up-to-the-minute info, remember SERV Robotics Investor Relations website and their SEC filings are always the best source.
If you found this discussion valuable, please do subscribe, like, and maybe leave a comment. Let us know what other topics you'd like us to unpack in future discussions.